All right. Hello, everybody. Thanks for tuning in and welcome to another Cash Flow Sundays. We're already at number 3. And today we're going to talk about everything that happened in the stock market last week. We'll be looking at, what happened. Apple had an event. Oracle had earnings. We had some macroeconomic news about the producer price index, consumer price index. So let's dive into it. Before we get to the meat and the bones of it, I'm wondering how everybody is doing. I just had a dinner with my daughter and my wife. And my daughter, she's quite small. She's only 5 months old. So she's starting to try all kinds of foods, and it's really cute to see what she can eat already. So that was my evening, and we just put her to bed, and now it's time for Cashflow Sundays. So let's get into it. And as always, we start out with our surprise of the week. And I was talking with an investor friend, and he was listening to the IPO about Magnum. I don't know if you heard, but Magnum, you know them from the ice creams. They are currently part of Unilever, and they're being IPO'd, they're being set up as their own independent company. And he was watching the presentation, and we heard a shocking number. The entire cost, the legal cost, the administrative cost of the operations to get Magnum its own business and its own ticker symbol and its own place on the stock market was roughly 800 million euros, just in legal fees, administrative fees, investment bankers. They take a big cut. And I think this is there's an important lesson in there. As you can see, Wall Street always makes sure that they are paid first. They receive the 800 million right up front. And next to that, there's very little known about this investment. There's no price set yet, so it's still very unclear what will happen. And I think a lot of big investors in Unilever are not really looking for a small ice cream stock to add to their portfolio. So that's something that we'll keep an eye on. So be sure to tune in every week from now on, and we'll keep you updated about what's happening over there. And that brings us to the real money movers this week. As always, we'll start out with the news. I don't know if you attended this, but there was an Apple event. Is anybody still interested in those? I think they used to generate a lot more hype, but currently they're, I've lost all interest. It's another iPhone. You can make pictures with it. There's a slightly better camera, slightly better screen, and slightly more expensive, and that's about it. But I think Apple as a business is still interesting to look at, and maybe we can compare it to Samsung later on. They had a new Pro, they had a thinner iPhone, new AirPods, new Apple Watch. Yeah, let's move on. Quite boring. I think what's more interesting is what happened to Mistral and ASML. Mistral is a French startup, and it's an AI startup, and I think it's the biggest AI startup that we have as Europe, against OpenAI and all the other big models from China. And a big company in the Netherlands here invested in Mistral, about 1.5 billion, and it's to boost their own production. And ASML is a big production company of chip machines, the machines that make the chips. So they supply to TSMC, they supply to Samsung, they supply to Intel, and they actually invested in this AI startup. And I think it's a hugely strategic investment for Europe as a whole to create their own AI infrastructure. Now we have the machines to create the chips, and then we also have the software that can run on the chips, and that can be cutting edge. Quite right now, Mistral is still a very, very small company. I think they're only about a fifth as big as OpenAI. But with a big cash injection from ASML, they could grow. And I think that's quite an interesting development. Nobody saw this coming. There were other companies looking out to invest in Mistral, but ASML was the one who ran away with it. Maybe there's some connection between the French CEO and Mistral being a French business. Who knows? But I think an interesting development. Next up, Oracle. They had quite a good earnings call, and I think they released earnings on September 9th, and their stock rose exponentially, and mostly because they have a huge order book, and their shares have already risen about 45%, according to this article. And there could be more in it. I think Oracle is a legacy business. They have a lot of data centers, and mostly a legacy business. So they're still in the AI game. They're still relatively new, but with their huge order book and their infrastructure that already exist in a lot of businesses, they could be quite well positioned to profit from this for the future. And the stock is already rising. I think that's quite good. Is there anything else interesting in this article? Yeah, they're betting on the AI cloud tools. Yeah, I have to catch my breath. I'm going too fast, and that happens. Thank you. Let's see. Yeah, they expect $500 billion in booked revenue just for their infrastructure business, and that's a huge uptick. And it's mostly generated by growing demand for relatively low-cost cloud infrastructure services. And I think one of the big competitors for Oracle is Microsoft. They have the huge infrastructure. They already have their huge ecosystem, Microsoft Teams, Outlook. You all know what they offer. And Oracle is still relatively new, so we'll be looking at them later on, and we'll be comparing the two businesses and see where they end up and how they match up to each other. Then Adobe. We talked about this last week as well, and they reported their earnings, and their AI sales are coming in strong. It's yet unclear whether they will lift the stock. Do you know if it's their entire year plan or only the final quarter? Yeah, I think about Oracle, they only talked about their quarter for 2025. And I think they raised their expectations for the entire year. And they released earnings up to up to last quarter. And what they will do this quarter is yet uncertain, but they expect to outperform what they set out to do at the beginning of this year. And if we move on to Adobe, we talked about that last week. They're coming in strong. Their AI sales are booming, and I think that's quite a big question around Adobe in general. Everybody was quite uncertain whether or not they could catch up to the entire AI race, whether they could develop their software into a product that people still want to use. If you compare it to what ChatGPT is already able to do, and there are a lot of newcomers and new players in the market that can drive Adobe out. I think Figma is a big one, but there are no players that offer the entire product suite that Adobe offers, and that's where they still have a big moat. A lot of people are used to working with Adobe and they want to keep using Adobe, but they're also quite expensive, or they're really expensive, and once you get stuck in their ecosystem, it's really hard to get out of. So I'm interested to see if they will still be the top dog in a couple of years from now. But currently they're doing well. Their shares were down a lot, but upon this earnings call, they rose up because investors got the confidence that they can catch up in the entire AI race and actually participate and be competitive. So that's interesting. We'll be keeping an eye on how this develops. And then next up, I think we cannot get around talking about tariffs and about Trump, even if he has been quiet the last few days. His tariffs and the effect of the tariffs, I think, is slowly starting to show. And the Federal Reserve, which is tasked, or one of the tasks that or one of their responsibilities is to look out for inflation and make sure inflation stays below 2%. And they look at the price development. And the producer price index talks about the margins that wholesalers and other businesses that deliver to the end customer, what kind of margins they make and how much their prices are increased. And this is quite an interesting market to look at, because these are the places that will feel, or they will get a hit. They will get a hit of the price increase that comes along with the tariffs. They would have to pay either more upfront when they import their goods, or they will have to take a cut when they sell it to the end consumer by not raising prices. And I think what we're seeing here is that their margins have decreased by 1.7%. I think this is a key takeaway. The rest of the article talks about the prices barely changing about 0.1%, so we can neglect that, but their margins dropped quite significantly by 1.7%, and this shows that it could show that they're taking a little bit of a hit on the tariffs. And if we look at another important summary that released last week on Thursday, is the consumer price index, and this is the price that the actual consumer pays, and we saw a massive increase by 0.4% for just 1 month. And over the last 12 months, or the trailing 12 months, that means a total increase of 2.9%, which is above the Fed rate of 2%. And everybody is expecting the Fed to decrease the interest rates. And what's actually quite interesting is that they will be having a discussion about this. And on Wednesday, they will have a decision about the interest rate. So then we'll know for sure. So we'll keep an eye out on that. And I think that's a great segue to what else is happening next week. September is usually quite a slow month. There's not much happening. We had a lot of the earnings seasons already behind us. I think Nvidia, Alibaba, Oracle, Adobe, those were some of the big names. We can expect FedEx, General Mills to report earnings, but I'm not really interested in those. Mark Zuckerberg will give a keynote. Yeah, I'm not really interested to be honest. Then we have US retail sales, could be interesting. But I think the highlight is the Federal Reserve interest rate decision. So if you want to hear about that, stay tuned and follow us. And you can follow us on the socials, on Insta, on TikTok, on Twitter, and we'll be talking about this. And as always, we'll be live on Sundays. So if you want to catch up on what's happening, stay tuned. And I think that's everything that happened last week, and it will happen next week. So now we're getting into the fun bit, and that's the stock market battles. For the stock market battles, we'll be using Market Daddy. This is the software that we developed. The reason why we developed it is because we felt there was nothing quite like this out there. We wanted to invest, and I have limited time to invest. I have a family, I have a full-time job, and I needed a platform that allowed me to take the time out of investing, but still give me an edge in the market. And that's why I created Market Daddy. We use AI to summarize a lot of data, and we display that through our software, and you can use it yourself as well. You can try it out for free for 7 days, and then you can cancel anytime. And if you like it, and we believe you will, you can subscribe to it for a small or for $10 or €10 a month. And you get a little discount if you subscribe for longer. And what we're trying to do here at Market Daddy, we're trying to make your money work harder. And we're here for the retail investor who is limited for time, who has a full-time job, who can't keep up to date with everything that's happening in the stock market. And we do that in 2 ways. The first is through our software, and the second is through our community. Every Sundays we'll be live on Twitch. There we can interact with each other. I can give some tips. You can ask some questions. We can have a good time, and that's how we will make sure that your money is put to work effectively and that you can invest for your families and your own future. So let's get into it. And I think it's an interesting way to pitch 2 companies against each other and see who comes out on top. And there are 2 interesting battles stock battles that I want to do. The first one is Apple. We just had the Apple event. There were some new products launched, which I think nobody was excited for. And we can pitch it against Samsung. And there are 2 different businesses. I think Apple is fully invested into its own ecosystem. They have the iPhones, they have the iPads, they have MacBooks. They're all really high margin products, and they sell a lot of services to all their users who are on these products. You have Apple Music, you have Apple TV, you have the App Store, and that's where they make most of their money. And I think they will continue building out that entire ecosystem, which could be quite high margin business. And then if you compare it to Samsung, which is a company that creates smartphones, but also creates televisions and displays, they create chips. It's a hugely more diversified business with more scale. There are more Samsung users than there are iPhone users, but their margins are a lot lower. So where should you invest, and how should you look at those 2 businesses, and how can you compare them? And there's a question in the chat. Would you recommend going for single share investments or an index for minimal risk or lose? I would, it depends on what you want to, on your own mindset and how you want to go about it. I'm very interested in the stock market and everything that's happening that's happening there. And for me, the better option, therefore, is stock picking. I think you can have a slightly higher rate of return if you know what you're doing and if you're willing to invest the time and willing to keep up. But it's a little bit more risky, and you have to invest the time. You have to know what you're doing. You have to feel confident, even if your investment can go down 50%. you have to stay. Yeah, you need to have the stomach to keep up with it. And I think for most people, investing in an index fund is the better decision. Low cost index fund, keep investing in the market. And a great way to look at it is as follows. Let's say this is the stock market, and overall you get a 7% annualized return. So if we draw that out like this, but the stock market never goes in a straight line, and this is the time, and this is the value of the stock market. As you can see, it goes up, but the way it goes up is like this. Now, the best way for you to make money in the stock market is to keep buying small pieces of the stock market all along the way. If it goes up, you keep buying, you put away a small amount of cash every month and you invest in the stock market. And if it goes down, you keep investing as well, and you continue doing this. And over time, you have big peaks, you will have low lows, but overall, you'll match the stock market. And that's the best way to ensure you have a relatively safe future investment, low risk and minimal time investment. Now, I still believe stock picking is the better choice if you're willing to invest the time, and if you find it interesting to do, you can outperform the market. But that's quite hard to do, and I think that's what we're trying to do here. And if you're interested in that, then you're in the right place. If you want to do index investing, I would recommend a low index fund and just keep investing over time. Yeah, single stocks are riskier and index is safer. Yeah, exactly. So if you have very little knowledge about stocks and don't want to learn about them, start investing in an index fund. And as you go along, you can still start investing in single stocks if you're interested in it. I find it a little more interesting to invest in single stocks as well. You get to keep up with it. You get to brag to your friends if you made a good investment, and they can talk you down if you made a bad investment. So, but that's to each their own. All right, let's start out with the Apple versus Samsung debate. Yeah, keep the questions coming, by the way. It's more interesting to have interaction than just talk here by myself to a screen. Well, if we look at Apple, what did they do last year? They were up at the beginning of the year. For the full year, they're up 6%. From September 2024 to September 2025. And when we look at a business, we want to look at three aspects. Is it a great business? Can we buy it for a great price? And can we reliably predict it for the future? Now, as said before, Apple is a high margin business. They have a few products, but their products are doing really well and they can sell services to their customers for high margins. Samsung is a business that's more diversified. They have more than just smartphones, but their margins are a little bit lower, but they can sell it to more people. So what is the better business? Now, Apple, I think everybody knows what they do. If we look at their AI analysis of their earnings call, we want to see, can they still grow? Is their cash position still good? Can they invest in themselves, and do they invest in themselves at a good rate of return? And are they not? Do they not have too much debt? What do they do with their shares? And do they have a good return on invested capital? Now, let's start out with their cash position. We can go to the balance sheet. We can look at their cash and short-term investments, and it's about 65,000. And we compare that to the short-term debt, which is roughly 21,000. So they have more than 3 times as much cash as they have debt. That's a very good liquidity position. So from a liquidity perspective, they're doing great. If we look at their return on invested capital. Return on invested capital is the money they keep over at the end of the line, at the end of the year. When the business has generated all their money, they paid all their people off, they paid all their factories, they paid for all their supplies. Then they can reinvest this money in other businesses or other ventures. And you want a high rate of return on those investments and their capital allocation. Now, 44% is really, really high. I myself aim at 15%. If a company is below that, then it's better for me to get that cash back so I can reinvest it at higher rates of return. But Apple is beating me at 44.3%, so I'm great with seeing that. So their cash position so far is great. Their return on invested capital, or the return on that invested cash is great as well. And if we look at their margins, like we said, a high margin business, they have 46% gross margins, they have a 30% operating margin, and a 23% or almost 24% net margin. And what that basically means is that 24 cents of every dollar they get to keep, that's what they get to reinvest at 44%. And that's the rate, at that rate, they can grow the business. So for an already large business, if we look at their market cap, which is 3.5 trillion, that's quite insane. They still manage to get some good growth. If we look at the revenue growth over the five-year average, they've grown about 10%. Last year, 2%, so that's a decline. They seem to be flatlining. Their cash growth also seems to be flatlining. Yeah, even though last year 10% growth is still quite good. Their return on invested capital has decreased as well. The cash position, liquidity is still good, and they do buy back a lot of shares. So from a business perspective, liquidity is good, low amount of debt. They have a great return on invested capital. They are a high margin business. Only thing is their growth is slowing down a bit. But I think for such a large business, I'm still okay with this. I think their mode is absolutely great. They have a high mode. Everybody knows the iPhone. I think it's very hard for a competitor to come along and outcompete with the iPhone or with the entire Apple product line. So they're quite well positioned for now and the future. I'm still interested what they will do with AI for the future. And I think everybody is still, they call it Apple Intelligence, which is also AI, but they need to have their own name. They can't just call it AI, which I think is a stupid Apple mentality, but let's put that point aside. I would still qualify this as a great business. And we got a question about dividends. They pay a small dividend, about 0.40% compared to the share price, which is quite low. I myself don't really need a dividend if they can get great returns on their invested capital, which they do. How do you find info over dividends? Yeah, you can look up the dividend info here as well. It's all in the software. How would you find the info? Have some passive revenue over the stock price itself. Yeah, I think you're talking about dividends. Dividends are basically a form of passive income over the stock. Usually you would want to see a higher percentage than 0.44. Apple pays a relatively small dividend, so this is not a dividend stock. If you want to talk about how you can find those shares, we can talk about that a little later on, because we have our own stock screener where you can search for companies that do pay a high dividend, and you can buy those and then have a little passive income on your investment. But a dividend is never free money. It always has to come out of the business. And then it's a question of whether or not you want that cash actually to be taken out of the business, or you want that cash to stay in the business where it can generate more returns. And I think Apple is a great case where they can reinvest their capital at such a high rate of return that I wouldn't want them to pay me a dividend, because I'd rather have it that they reinvest it in themselves for the 44% return. And then I will just take the payment when I sell the shares of Apple. But that's to each their own, and it depends on how you want to run your investment and how you want to set up your portfolio. But from a business perspective, I think Apple is still doing great. If we look at the price perspective, I think they're quite expensive. Their price to earnings is 37. That means you pay 37 times what they do in operational earnings. Market average is about 15. You're willing to pay more for a high margin growing business with a strong moat. I think Apple is a business with a strong moat, is a business with strong margins, but they don't show growth, or they show a little bit of growth, but not anything spectacular. So from a valuation perspective, we can actually see if they're overvalued or not by using our price calculator, or value calculator. They basically keep the dividend percent super low to keep punching the stock prices up and to make the investing more attractive. Yeah, exactly. They basically reinvest in the business, they reinvest in themselves, and therefore as a business they can grow quicker, and that will lead to a higher share price. That's the theory. If the whole if something happens, I think Apple has a little bit of a China dependency in their whole supply chain. The stock market can still tank, and then dividend is a safer return than stock price. So there's a little bit more risk involved, but that's the gist of it. Now, if we look at the valuation for Apple, they grow, their business record is a 13% growth, and we can use 3 scenarios, our best scenario, our normal scenario, and our worst case scenario, to kind of predict the current value of Apple if we take their current growth numbers and extrapolate them for the next 10 years. And you always want to pay, every investment is the price of the future cash flow. So you want to see where can the future cash flow take this business. I want to pay a price now to get a return in 10 years. And that's how you find value. If the company currently is worth more, according to your valuation, than the stock price, then the company is undervalued, and it could be an interesting buying opportunity. If the value of the company is less than the current stock price, then the company is overvalued, and then it's not looking like a great investment based on your assumptions. Yeah, have a good night. And good luck walking the dogs. Thanks for tuning in. Much appreciated. Let's look at all the scenarios. Best case, let's say they can keep growing at about 15%. I think for a normal case about 10, and worst case, I think they can about 12. I think best case will be about 12% growth for 10 years. Continuing is quite significantly good, especially for a business that's worth 3.5 trillion. Their exit multiple, if they would still grow by 12% for the mode, I would be willing to pay a little bit more. If they're growing less, I would lower the exit multiple, and worst case scenario, I would lower it even more. Now, my desired rate of return is 15 in all cases. And let's see. Yeah, it's currently overpriced according to my scenarios and my calculations. So it's a great business. It's a little bit overpriced. And predictability, I think Apple is quite a predictable business. You know what you're going to get. They're going to release a new iPhone every year. They're going to do a little innovation, but they're mostly going to generate their money based on the services that they sell, which is a high margin business. But they can only grow it as fast as they can grow their own customer base, and I would expect there to be some limit on how much money they can make on their current customer base. Still, from a business perspective, I think it's a great business. I would be willing to pay a little bit more, but I still think it's overpriced, and the growth is just not there to be willing to pay that much money for it. So that's Apple, and I want to compare it to Samsung and see how they differ. Now, Samsung is slightly different. They make smartphones, home appliances, memory chips for consumers and businesses, and their model is built on innovation and technology. They earn money through product sales and services. They have a strong brand. They have a diverse product range. I think that's a big differentiator from Apple. Apple is very focused on their iPhones, their MacBooks, and selling services on those products, whereas Samsung has a way more diverse product range. They're also more focused on businesses, not just consumers. They saw an 11% increase on their DS division. I'm not sure what it is. Due to high-value memory products. This is a durable edge in memory technology. Yeah, they do a lot of memory stuff. They sell a lot of SSDs. I would expect that to fall under the DS division. They show potential for compounding growth in first quarter 2025. They had quite a strong revenue growth due to their Samsung Galaxy S25 sales. They faced a 16% drop, indicating volatility in smartphone sales. Yeah, I think Apple is a little bit more stable there, but Samsung is experiencing some volatility. What are their future expectations? They anticipate a gradual recovery in the second half of 2025, driven by AI and robotics. And I think AI, every company is talking about AI. I always want to see what's behind those words. What are they actually doing with AI? Where are they driving revenue from their AI innovations, or where are they cutting costs? It's very easy to talk about AI, but I want to see the actual numbers backing up their case. They're focusing on high-value memory products and AI-driven offerings. Monitor the performance of the DS division as it drives revenue growth. Yeah, smartphone sales are apparently down. Now, again, we ask the same 3 questions. Can we get a great business for a great price that we can reliably predict for the future? If we look at their growth rates, their last year growth rates were quite good. Their 5-year average, not too great. From a cash flow growth perspective, last year they had a peak back up, but there was a downward trend. Their return on invested capital is a lot less high than Apple, about 10%, not too great. Cash to debt position is a lot better, so liquidity is still good. Shares outstanding, they do a little bit of buybacks, but not as much as Apple. If we look at their margins, their net margins is about half of what Apple does. If we look at their market cap, this is in Korean won. It's kind of hard to compare to US dollars. Maybe we can look at our cash flow statement and see what they generate in cash. Yeah, last year it was actually a negative year for them. I want to see some stability here and growth. It's very unstable, and they do about the same Korean wons in cash flow as they did in 2016. So there's not really any growth there. Their margins are significantly lower. Their return on invested capital is significantly lower, and this opens you up to more risk. If they get to keep less from each sale they make, their business is more operationally, they require more cash to be able to run. So if you sell less, or if you have less pricing power, if you need to sell for lower prices, there is less maneuverability, and you're vulnerable in a downturn. So it's already looking like a business that's less good than Apple. And I think their sales trend is lower. So from a business perspective, is it looking like a great business? I think their cash flows are unstable. Let's give them the benefit of the doubt. No, I want to say it's a good business. It's not great, it's just good. If we look from a pricing perspective, can we buy it for a great price? If you can buy a good business for a great price, it could still be a great opportunity. But I'd rather buy a great business for a good price than a good business for a great price. Their price to earnings is significantly lower. What did they do over the year? They grew a lot more, about 12%. So if you just look at price, it would be a better investment, but that's not the investment style that we teach here. We want to look at the business. That creates a lot more of a safe investing fundament, and that's what you want to take. That's the approach you want to take when you look at the market. You want to buy a better business for a great price, or you want to buy a great business for a great price, and not just go off price of the stock. You want to look at the fundamentals of the business and see if the story is backed up, if there is a good investment case there, and that's where you make your money, not on whether the price is going up or down. Price is not an information point; it's only there for you to take advantage of. Now, if we go back to can we buy it for a great price, the valuation is a lot lower. They pay a higher dividend. Their earnings yield is a lot lower. But let's put it into our calculator. Let's say they can grow by 10%, which is above their business record, so it would be best case. Let's say they match their business record revenue growth for normal case, and let's go 3%. Then we have an equal division amongst best, normal, and worst case. See how they do. Exit multiple for 10% growth. Let's say we're willing to pay a 10. An 8 and a 6, and we're still looking for 15% return. Let's see if it's over or undervalued. Yeah, this is also significantly overpriced, so we can't buy it for a great price. It's just a good business, and predictability for Samsung I think would be a lot lower. I think Apple was a lot easier to predict. They have less product lines. Samsung is more diversified, which could be a protective asset for them. But I think the moat that Apple has in the business that they're in, their smartphone business, their laptops, their MacBooks, I think that's a lot stronger business, a lot more reliable, a lot more predictable than Samsung. Samsung, because they're they're split across many divisions, it's hard to keep up with each division. Their smartphone sales are up and down. They are not as strong of a margin business as Apple is. So if we pitch Apple versus Samsung. Apple is a better investment, but in my book, Apple is still not the investable company. However, Apple wins based on their brand, their moat, their sticky ecosystem. And if you look at it from a fundamental perspective, they're also the better business, but they are also significantly overpriced. Samsung wins out in their diversifications, and I think they're a bigger manufacturer. They make the chips, which is a huge hype right now. But it's also a little bit cheaper. It's still overvalued, but it's a little bit cheaper. If you want to invest in one of those two businesses, Apple I think is the better play for the long term. But always do your own due diligence. Don't just buy something because someone on the internet is saying that it's a great buy. Look at it from your own perspective. See if it fits your style of investing, and if you want to own it, yes or no. All right, let's move on. And I think that's our next battle. We're going to pitch Oracle versus Microsoft. We just talked about Oracle. They shocked Wall Street with their earnings and their entire order book. They had a lot of AI cloud contracts. But can it actually take on one of the biggest players in the AI ecosystem right now, which is Microsoft? And I first want to look at Oracle. Let's see where they are. Here we go, Oracle. Let's load them up. Now, Oracle is not a new kid on the block, but when it comes to the AI race, they absolutely are. They have a lot of legacy business in their in data centers for corporations and for other businesses, and they currently increase their cloud division, and that's where most of the AI hype comes from. They're still relatively small. They're valued at about 800 billion, which is massive. But Microsoft, I think, is around 4 trillion, which is significantly bigger, almost about more than 4 times bigger than Oracle is. So that's massive. And Microsoft has a huge moat. Everybody knows their ecosystem. Everybody is using it. It's very hard to compete. And I think Microsoft is one of the biggest winners of the AI race as well. But we want to look at it from a more fundamental perspective. What is the better business to buy right now, and why? Can we find an explanation for that? And we do that by using our software. This allows us to get all relevant stock market data at the click of a button and see and analyze whether or not this is a company that we want to own for the long term and where we want to put our money to work, yes or no. Okay, Oracle, again, same 3 questions. Can we buy a great business for a great price, and can we reliably predict it for the future? Let's start off with with what we see here. I want to look at the price first. Over the last 5 years, they've grown 380%. That would not be a bad investment. Last year, also about 100%, but a lot of the uptick is in the last few days. And if we look at their revenue growth for the last 5 years, it's about 10%. Last year, about 8%. And only current quarter have they shown a significant deviation from the trend by peaking upwards in revenue growth quite significantly. And expectation is that they continue to grow their revenue by more than what they expected before because of their huge order book in the AI cloud ecosystem. If we look at our free cash flow growth, it is negative. They have shown a decrease. So we'll be taking a closer look at that later on. The return on invested capital, it's okay. It's not great. Roughly 10% on average. Their liquidity position, it's okay. Also not great. And they did hand out more shares than they bought back. Let's look at their recent operating margins. These are actually quite good. I would expect this from a cloud-based business, from a software, it's not entirely software, more an infrastructure, AI cloud infrastructure business. You would expect high margins. High margins are good. They have about a 70% gross margin, 30% operating margin, and let's round it up, 22% net margin. And that means that 22% from every dollar they make, they get to keep. And with that, they get to reinvest it in the business, pay off some debt, buy back shares, hand out a dividend, or do mergers and acquisitions. So they have a great margin business that positions them well for the future. Of that cash they keep, they reinvest it at an almost 11% rate of return, which is the most recent number. That's relatively good. It's better than the market average. I always aim at 50% for my own investments, so it's still below that, but it's not too bad. And we would expect this to grow in the near future because of their huge AI order book. And the biggest question is whether or not they can keep up that order book and keep filling the order book. So from a business perspective, yeah, I think that we can qualify this as a great business. If we look at a price perspective, let's use our price calculation tool. They've shown about 11% revenue growth. Let's say their whole AI play pays off massively and they manage to grow it above expectations and above what they have historically done, which could be the case. Everybody is investing in AI and Oracle could be a big winner of that. So let's say they reach 15% revenue growth over the next 10 years. Let's say for the normal case, they equal what they did. And for the worst case, they underperform slightly. Now, if they manage to grow 15%, I'm willing to pay more. But how much? Let's put it at 20. 15 for the normal case and just 10 for the worst case scenario. Now, I aim at a 15% rate of return. It's also overpriced. I think with a huge uptick, I would still agree with this. And the reason why is because we get to the third question. Can we reliably predict it for the future? They have shown a great order book uptick, but can they manage to actually deliver on all those orders? And can they manage to get more orders in their order book? If the economy were to slow down, which could happen, we can never predict when it happens. We only know that it will happen at some point. Will these orders still come through or will these just be cancelled out? I think that's quite a risk you're taking on. Their legacy business is still doing great, but you're overpaying for their legacy business. And you might think that could be a great investment if you believe in a growth story. I think they can grow, let's say 20%, and you would be willing to pay 25 for that. Their normal case, they still outperform, and this would be about 10. Let's see what it does with the valuation. It's still overpriced. So I think it's not a great, let's say it's a great business. You can't buy it for a great price, and it's not that easy to reliably predict for the future. So in my book, it's not the best investment. Now I want to compare this to Microsoft, which is the incumbent. They are the biggest player on the block. They've grown massively, and I think that they're one of the biggest winners when it comes to AI. They have OpenAI. They have their own software suite, and they can supercharge it with all their AI tools. They have a lot of cloud services. They are everywhere. They're really everywhere. They have the software, they have the hardware, and they have the infrastructure. And they have a great business model. They have all the subscriptions. So from a business perspective, I'm already inclined to say this is a great business. But let's see if that's true. Let's look at the revenue growth. We see upwards going graph quite steadily, and they're still growing about 15% year on year. Great. Free cash flow growth. Last year, it dipped, probably due to high investments or capital expenditure in their AI expansion and the growth of Azure. So it hasn't grown, but they can put it to use. And you see that by the return on invested capital, which is close to 15%. Their liquidity rate is still very high, well above 1. That's what you want to see. If it's above 1, it means they have more cash than they have debt. And they buy back some of their shares. Now, if we look at their latest return on invested capital number, this is 22%, which is significantly above what I aim to make in the stock market. So that's already great. That's what we want to see. If we look at a margin perspective, they make higher margins than Oracle. They have a 36% net margins to Oracle's 22, I believe, on the top of my head. So they get to keep more from every dollar they sell, and they invest it at a higher rate of return compared to Oracle as well, even compared to me. So that's quite... these are the signs of a great business. So is Microsoft a great business? Yes. Now, can we buy it for a great price? First off, if we look at our valuations, they're quite highly valuated. 36 times earnings, on almost 4 trillion market cap. It's still insane. Price to free cash flow is even higher. They pay a small dividend. And I think I would be willing to pay a higher price for Microsoft compared to Oracle. Why? Because they already have a bigger market cap, so there is a higher moat. They show better growth numbers. Now Oracle as the better perspective. Microsoft is already huge, so it's a lot harder to grow from a perspective where you're already huge, whereas Oracle has a lot more runway to grow. But if you look at the data, Microsoft is the better growing stock if you look back a few years. From a free cash flow growth perspective, they've done great. I think it recently declined because of more investment, more capital expenditure in AI. And they invest their cash at a great return. Absolutely great business. We would be willing to pay a higher multiple for this. So let's put it into our valuation tool. If we look at revenue growth, that's best case scenario. I think this is quite a stable business. There won't be huge deviations. So let's keep all the revenue growth percentages quite close together. For 15% growth, I'm not willing to pay 36, but I would be willing to pay for Microsoft 30 might be a little excessive. I would be willing to pay 25, and then 20 and 15. Now these are quite conservative, and it shows that it's currently overpriced, and I would relatively agree with it. I would maybe call it fair value, but definitely not undervalued. Microsoft is a stock that I keep a close eye on. I think it's a great business, but currently I can't buy it for a great price. Can we reliably predict it for the future? I think so. I don't see them going anywhere. Their product suite is really strong. They have a strong moat. It's really hard to outcompete them. And when we talk about a moat, the way I look at it is if a competitor would arrive on the scene with an amount of cash equal to the market cap of Microsoft, so 4 trillion, which is very unlikely, but in this theoretical scenario, let's say this happens, can they instantly compete with Microsoft? I think there's no chance in hell that can happen, for the very simple fact that Microsoft is already everywhere. Everybody is used to working with Microsoft. They have a huge suite of tools, products, software. It's really hard to outcompete them. So they have a really strong moat. They have a lot of opportunities for growth. They own part of OpenAI. So from a reliability perspective, I don't see them going anywhere. I see them growing very well, very happily, very steadily into the future. I just think they're overpriced. So for me, great stock to look out for. Better investment currently, if you look at the fundamentals, than Oracle, but overvalued. So let's put it on our watch list, or it is already on our watch list, but let's put it there at a different price. Maybe, yeah, I think it needs to significantly decrease. So let's put it there at 400. If it ever hits 400, then I'll be interested. But that's going to take quite some time. There's quite a big gap between what it currently is and what I'm willing to pay. So I could be waiting a long time. But I'll keep an eye on it, and you never know what happens. If tomorrow something strange happens, the price could drop. We've seen greater drops in worse market conditions. I think the market is currently at an extreme peak, and therefore there is a lot of room for stocks to decrease in value. And that's when I'll be ready to strike. Now, those were our stock battles. If there's still anybody interested to look at a certain stock, let me know. Then we can discuss this as well. If not, then I think there is another interesting thing to look at, or another interesting update. Last week we talked about Google. We talked about the business and whether or not it's overvalued or not. And I actually sold my shares in Google. I bought them around, let's say here, November 2023. They were around $86 per share, and I sold them at $240, which is a little lower than they are now, or about what they are valued at right now, which is quite a good return. And the reason why I sold them is I think the growth perspective that they had is gone. They've made a great uptick. I think their cloud services are doing well. Their AI products are doing well. I think the business is still great. From a price perspective, they're currently overvalued. And from a reliability perspective, I think they have a lot of competition. It's still unclear how all the other big players will monetize their AI models. Google used to have their search engine that was a huge generator of revenue. They have YouTube that still generates revenue, but I think there's competition all around them. And for the longer term future, I still see them being around, but I'm unsure whether or not they're still the big player that they are now. So that's why I decided to sell. I will still be keeping a close eye on Google, but for now, I took my money and reinvested it in Genmab. Now, we looked at Genmab as well last week. There's a stock analysis over on our YouTube channel. So if you're interested in Genmab, go take a look at our YouTube channel and you'll hear me talk about it. Now, before we go out, there is one more tip, and that's the book tip. And for this week, we have the Black Swan by Nassim Nicholas Taleb. I think it's one of my he's one of my favorite authors. He makes very bold statements. I think he's a lot of fun to read. It's very easy to get through. And he has quite a philosophical angle to whatever he writes. So it's not necessarily only about investing in the stock market, but it's about looking, a general outlook at life and our society. And the Black Swan is about the unexpected and the impact of he calls it the highly improbable, and the impact of the highly improbable on societies or on ecosystems. It's quite a well-known phenomenon these days, the Black Swan, but it's still very interesting to read his perspective on it. So definitely a big recommend, the Black Swan. All right. Now, then we're about done with our live stream. If there are any questions, let me know, and we can still discuss them. We used our over here at Market Daddy. We're here for you, the retail investor, and you're probably interested in the stock market. Maybe you've invested before with little success or no success, or you feel yet unsure and not very comfortable in where to put your money. And that's where we come in, and that's where we help you. We're here to help you find the winning picks in the stock market and to find the right way to invest in the stock market. And we're here to teach you the process. Now, never go out and buy something because someone on the internet says to buy something. There's a lot of bad advice over on TikTok. Please let it be, and follow your own course. And we help you decide your own course and put your money to work so you can invest for yourself and for your family's financial future. And it's very interesting to know who you're up against, and to know your edge. There are a lot of investors out there. There are a lot of institutional investors out there. There are a lot of institutions that use algorithms to invest in the market, and it's very difficult to outperform them if you play the same game. So you've got to look at it from a different perspective, and that's what we teach here, and that's why we use our software to help you understand the businesses you're buying into, to gain quick access to data, and while we use our live streams to keep you up to date on what's happening in the stock market and give you all the important information to act on or not. But it's here for you to take advantage of. You can ask questions. It can be an interactive show. We can help you get your investments on the road. All right, that's about it. We're gonna wrap it up, and we'll be back next week with another Cashflow Sundays. Thanks for watching, and see you then.